investment market briefing.
In our survey, the first of 6 simple high-level questions that we put to our respondents was, looking across all global regions presently, which global region did they believe was the most attractive for making investment purchases this year? Europe, Western Europe and Central and Eastern Europe came out as top choice. 56% of investors this year preferring one or other of those 2 regions, although as you can see, some slippage in the attraction, it would seem, of Western Europe, some increase in the attraction of Central and Eastern Europe. Asia, around 20%, significant pull on European investor interest, and an uptick this year for the attraction of North America. First question to the panel. Any comments on observations on that?
The numbers, I mean, whilst it's a fall in sort of Western European markets, I think it still, dominates people's intentions in terms of focused on Western Europe. As we'll talk about later, most of that really has come, a lot of it's come to London and Paris in proportion. I think the US is beginning to see recovery, and certainly when we were in the States last week with our team, the New York market, really the East Coast markets, have seen a strong recovery now, just very much like London over the past year or so. And now I think the general economic sort of numbers are beginning to improve, and so I think a number of European investors are beginning to find interest over there. I suppose one of the interesting things is CE, the markets there are beginning to improve, and so we've seen interest now, more interest I suppose than Poland and Czech, and then a little bit more interest in the more eastern markets. Asia, you mentioned, I think is an interesting area. We see huge amounts of growth continuing in that market, and I think a number of investors are beginning to head back to those Asian markets, and we do see continued movement towards Australia, interestingly enough, even though the currency is very strong.
On the question of within Europe, which country or region do you believe to be the most attractive for making investment purchases this year? And it's particularly interesting to contrast the 2011 results with the picture that we saw last year. Last year, early 2010, was the UK, which stood out as being the most popular choice for investment, attracting over 30% of investor votes. This year, we see really quite a strong change. The UK's share sharply down, as is that of France, and what we see is a big shift towards Germany now as the first choice.
I think that, come back to Germany maybe, but I think looking at UK and France, you saw the numbers. London and Paris have seen a huge amount of investment as a key target in the European markets from all over the world. And I think that you've seen such strong repricing that now some of the other markets are beginning to see, relative attractiveness. And I think with Germany beginning to see some stronger growth and some focus now on Poland.
I think it's interesting to look at the economies that are a little bit more finely balanced, and definitely if you look at Spain, you can see smaller investment volumes, but investor intentions are that they want to see increased investment there. If you do look at Spain, there are regions within Spain which have actually fared very well in the last cycle and haven't really gone into recession at all. Catalonia, Pays Basque, for example. And I definitely see a sentiment among investors that they will take that country risk. They're taking the bet that Spain is going to come out of this perhaps stronger than some of the other countries that are more in balance, and we're seeing an upswing in investment there.
Another dimension in Europe, which sector is the most attractive for investment purchases this year? And here we see offices still very popular, but slightly less popular than they were in last year's survey, down now to 35% as first choice. But the significant feature, and again in terms of the change and shift in sentiment this year, is the higher attractiveness of retail, or all retail categories as a whole there, touching 43%. That I think is the main story I take from this question. Don?
Yeah, I think that's right. I think firstly you've still got a backdrop of many investors who've had a fairly long-term desire to increase their weighting to retail anyway. So it's seen as less specialist And if it is specialist management, which of course it is, the right management skills are out there that you can employ. So I think that's part of the story. I think secondly, that these markets such as Germany, such as Poland, which are recovering quite strongly and seeing good growth, it's a good sector to invest into to benefit from that growth, because as the consumer starts to feel a little bit more comfortable again, then that gets reflected fairly quickly into turnovers and retailers' desire to expand in those markets, which then puts pressure on rents. So I think it's those two factors. I think it's tied to economies improving and also just a reweighting into the sector, which a lot of investors want to achieve.
In the survey, we asked the question of our respondents, what do you think will happen to the prime secondary yield gap in 2011? And we got a very interesting divergence of views, as you can see here. About 36% of our sample thought the gap is going to stay the same. This differential in pricing is going to be maintained. 27% thought the gap would narrow, but 37% thought the gap would widen.
Some of the results are being slightly distorted by people's interpretation of what is secondary. If you actually sort of ask the question about prime versus secondary and classify secondary as really quite poor quality property, shorter term leases, poorer quality tenants, I think most of the market would take the view that perhaps there is further movement out of the yields in that sector. Whereas if you take a secondary property and classify it as something actually that is actually good quality property, but it has one characteristic of either a shorter lease but good quality property and good tenant, or it's got a poor tenant in it, that market where it's sort of value add, where people can add additional value, I think we're actually seeing those yields contract, come in. So you could actually get the same, two completely opposite answers to the same question, depending on your classification of secondary. So the general view seems to be that with the shortage of stock, we're seeing at the better end of the market a lot more demand coming through, and therefore seeing much more tighter yields coming through. And at the prime end, I think there is, with where interest rates are and gilts are, there is actually pressure even there to see perhaps yields tighten a little bit. So you can start seeing how the divergence of opinion coming through there. And I suppose again you can also look at into the occupational market and the pressure on rents that are coming through. And clearly again that's going to impact on value, and the further, more secondary you become, more concern there is about either releasing risk and also the levels of rents that will be achieved.
When will be the right time for you to invest in secondary? Not very many of our respondents thought now, i.e. the first half of this year, was the right time, it appears, to invest in secondary, but just over a quarter, 25%, thought in the second half of 2011. But interestingly more, over 30% thought next year, and indeed over 30% thought later, i.e. beyond the end of 2012.
I think it does depend on the market, and clearly we do have some secondary property for sale at the moment. And in those stronger markets, particularly I'm seeing in Germany, but also in Poland, I believe that there is actually increased interest in secondary, good quality secondary, and also for the type of building where you can genuinely influence the performance of it. So we're involved in some German real estate at the moment where you've got secondary property, but where there are genuine opportunities to invest into the building, to increase value, to work with tenants, replace tenants and improve the situation. That type of secondary property, I believe, actually the yield's coming in for right now. But it's very different from sort of building which is perhaps single let, where your ability to influence is not at a tenant level, and people aren't buying into that type of secondary property where in order to get yield shift with the market. So I think it does depend on the property and it does depend on the market, but I am seeing for the right buildings in the stronger markets actually people taking a view that secondary property is the place to start investing in.
And I think another point to bear in mind, I think the back-ended delay in people coming into the secondary market is very much going to be influenced by the debt market. The debt market out there, and generally people buying secondary do need to secure debt. The banks are not really in the market to lend on that quality of stock yet. Until we start seeing perhaps a re-emergence of a securitisation market with the impact of Basel II coming through, and the issues of holding this stuff on balance sheets is actually deterring the market, and they're really looking for the banks are only really lending on the very best type of property. So until we start seeing a bit more liquidity in the banking market, it's very difficult to see how we can see the secondary market sort of coming back in. And I would imagine there's a lot of the delay is people saying, well, actually to try and go and acquire today will require too much equity, and therefore we're going to delay our entrance into the secondary market.
Respondents again this year, which are the following of a pre-selected list that they think were the biggest threat, the single biggest threat to the recovery of the property market. And here again, we saw a big shift in sentiment compared to the situation a year ago. A year ago, concern was really dominated by fear, if you like, of a double-dip recession, of a relapse into a downturn. There's still concern about weak occupational demand, but two other factors have seen increased concern this year and moved into the sort of top spot, and that's shortage of debt finance and now interest rate rises and inflation. Panel, what do you make of that?
The big issues for us are, huge amounts of capital, moving around the system. I think there are, risks out there, but, the real estate markets are proving hugely attractive to new capital. But, we're seeing sovereign fund capital now, being very attractive towards real estate globally. And I think that's, quite an interesting trend. We saw, you talked about Asia earlier on being a target for capital. It's now a huge source of capital also, and Asian capital heading towards the European markets is becoming quite important with them, not just the Koreans, but the Malaysians, the Chinese, and becoming increasingly important.
The point coming back to the debt side of things, the debt market is going to overhang the overall recovery and the sort of increase in activity levels. Clearly there doesn't seem to be a shortage of equity. It's the other risk profiles that are where there is the great shortage at the moment, and the banks have really only just started to deal with a lot of the issues in terms of the volume that they've got to deal with, partly because in the earliest part of the cycle they weren't able to address anything because of the shape of their balance sheets, but they actually pushed back quite a lot of maturity dates by 1 or 2 years in the prospect that the market would improve. So hence the reason why we're seeing this increased amount that comes through this year, next year, and until 2013. So that's really going to dominate and hang over the market. Clearly, the equity level, the very prime stuff, there is no shortage, and there will continue to be activity in those levels. It's the next tier down where debt is going to be required, where there's be less liquidity.
I was just going to pick up on the occupier demand part, and specifically for retail. I mean, what is quite interesting now is that clearly we've been through some very difficult times, but when we're looking at specific assets now, at least we can work out where the winners are and where the losers. We can see what's happened to footfalls, we can see what's happened to turnovers, we can see what's happened to vacancy levels. And what is quite interesting is that investors are able to look at this period and actually choose the assets that have defended themselves very well. So it's actually really helped in some definition between what is good and what is not. And I think a lot of the risk as to where individual assets are going to go in the future is now understood and starting to be reflected fully in pricing.